Here is the complete spoken YouTube finance script. One headline crushed SMCI by 33% in a single trading session. But the bigger question right now isn't what happened. It's whether the real data underneath this wreckage tells a different story. Supermicro shares plunged 22% after the Justice Department arrested the company's co-founder and two others for allegedly smuggling $2.5 billion in servers containing banned GPUs to China through a scheme involving Taiwan and Southeast Asian shell companies. That is an extraordinary number. And for a stock that had already been battered by accounting controversies, it was the kind of headline that makes most investors reach for the sell button without even reading past the first paragraph. Today we are going to go further than that headline. We are going to look at what the actual charges are, how management responded, what Wall Street analysts are saying right now, and whether the bull case or the bear case has more weight behind it. Let's get into it. What happened to SMCI? SMCI reached its all-time high back on March 8, 2024, with a price of $120.90. Since then, it has been one of the most volatile stories in the entire technology sector. Supermicro has delivered a roughly negative 37% change over the past year, with a 52-week range between $19.48 and $62.36. The stock has now shed a massive portion of its value from peak levels. Supermicro has had a brutal first quarter of 2026, with the stock sitting well below $30, down roughly 28% year-to-date and about 35% in just the past month alone. The core event that triggered the most recent collapse was a federal indictment unsealed in Manhattan. Federal agents arrested Yi-Xian Wally Liao, a prominent Silicon Valley executive who co-founded Supermicro back in 1993 and is a close confidant of CEO and Chairman Charles Liang. According to the Department of Justice, an indictment was unsealed in Manhattan federal court charging Liao and two others with allegedly working in secret to divert billions in Supermicro AI servers to China in violation of U.S. export control laws. How serious are the allegations? This is where you really need to understand the layers here. Prosecutors claim that Liao, along with Supermicro's Taiwan general manager Rui Tsang Stephen Chang and a fixer named Tingwei Willie Sun, routed servers with banned NVIDIA H200 and B200 GPUs through an unnamed Southeast Asian company to Chinese buyers. The scheme involved efforts by the defendants to evade scrutiny by auditors from both Supermicro and the U.S. government, including by falsifying records and setting up dummy servers where they removed and affixed serial numbers with a hairdryer. These are specific, detailed allegations. The DOJ's own indictment contained a staggering figure. The indictment revealed that between late April 2025 and mid-May 2025 alone, over approximately $510 million worth of servers assembled in the United States with NVIDIA GPUs and subject to U.S. export controls were sold. That is $510 million in a single month through this alleged channel. And this is not the first time SMCI has faced this type of scrutiny. The company settled SEC charges of accounting fraud back in 2020 for $17.5 million and faced fresh accusations of accounting manipulation from Hindenburg Research in 2024. According to a lawsuit filed in April 2024, Supermicro waited only 3 months after the SEC settlement before allegedly restarting improper revenue recognition, recognizing incomplete sales, and circumventing internal accounting controls. Then EY, one of the most respected audit firms in the world, resigned as Supermicro's auditor in late 2024. EY told the board's audit committee that it was concerned about the governance, transparency, and internal controls over Supermicro's financial reporting, which in auditor speak is a significant red flag going straight to the corporate board. That is an extraordinary chain of events that has been building for years. What management has said and done. Give them some credit here for the speed of response, at least on the surface. Supermicro stated that the U.S. Attorney's Office unsealed an indictment of 3 individuals associated with the company and that Supermicro is not named as a defendant in the indictment. On March 20th, Liaw resigned from the board, and the company also announced it appointed Deanna Luna as acting chief compliance officer, effective immediately. Prior to joining the company in 2024, she had overseen export licensing at Intel Corporation. Beyond personnel moves, management launched a new formal investigation. Supermicro launched an independent investigation into the indictments, with the probe being led by 2 independent board members, including former Deloitte audit partner Scott Angel. The board's independent directors also retained the law firm of Munger, Tolles, and Olson, which in turn retained Alex Partners as an independent forensic accounting consultant. That is a serious set of names to bring in. Meanwhile, co-founder Liaw pleaded not guilty in New York to the charges that he helped illegally divert billions of dollars in NVIDIA-powered servers to China. Analyst targets and revisions. Wall Street right now is deeply split on this name. The 16 analysts covering Supermicro stock have a consensus rating of hold and an average price target of $35.81, which would represent a roughly 54% increase in the stock price over the next year. The lowest target sits at $22, and the highest reaches $64. That is an enormous spread, and that spread tells you everything you need to know about the disagreement in this market. On the bearish analyst side, Mizuho cut its price target from $33 to $25, citing near-term legal risks and the possibility that orders shift to competitors like Dell. On the more bullish side, Needham maintained a buy rating with a $60 price target, applying a multiple of 16 times to fiscal 2027 non-GAAP earnings per share estimates of $3.70. Among 19 Wall Street analysts, the current breakdown is 8 buy ratings, 8 hold ratings, and 3 sell ratings. Oh, the bull case. Here is where things get genuinely interesting. Because the fundamental business underneath this governance mess is not terrible, it is actually growing at a remarkable rate. Supermicro's revenue for the most recent quarter came in at $12.68 billion, beating the estimated figure of $10.42 billion, and the next quarter is expected to reach approximately $12.39 billion. The company demonstrated revenue increasing 153% quarter-over-quarter to $12.7 billion, with projections estimating revenue to reach at least $40 billion for fiscal year 2026, representing a year-over-year increase of 82%. On valuation, this is where the bull argument gets its real muscle. The trailing price-to-earnings ratio sits around 16 times, and the forward PE is under 9 times. For the hardware industry, the median forward PE ratio is 20.80. That means SMCI is trading at a significant discount to its own sector. Management also claims to have shipped at least 60% of worldwide liquid cooling solutions in the last 12 months, a real competitive moat in AI data center infrastructure. And the company held an order book of more than $13 billion in Blackwell Ultra orders as of the first quarter. Insider activity points in an interesting direction, too. 68 recent insider transactions have skewed toward net buying, suggesting those closest to the business see value at these levels. The bear case. The bear case is equally concrete. GAAP gross margin fell to 6.3% in Q2 fiscal 2026, down from 11.8% a year earlier. Margin compression at that speed is not a rounding error. Total liabilities surged 502% year-over-year to $21 billion, including $4.6 billion in convertible notes. That is a balance sheet that demands attention. Then there is the NVIDIA dependency risk, which is genuinely existential. The vast majority of Supermicro's revenue comes from GPU-centric products tied to NVIDIA, and the company has no long-term supply contract with NVIDIA. Supermicro accounts for about 9% of NVIDIA's revenue, according to data compiled by Bloomberg, meaning if NVIDIA ever distances itself, the business model cracks. At least 7 securities fraud class action lawsuits have been filed, with the class period covering April 30th, 2024 through March 19th, 2026, and CEO Charles Liang and CFO David Weigand named as individual defendants in at least one suit. That is years of litigation overhang minimum. Technical setup. The stock sits 63% below its 52-week high of 62.36 and just above its 52-week low of 19.48. That 19.48 level is your critical near-term support. If it breaks that, there is not a lot of technical structure below it. On the upside, there will be some resistance from lines around $34 and $36.64, and a break above either of those levels would issue buy signals. The 200-day moving average is sitting well above the current price, which tells you the broader trend remains damaged. Short interest currently stands at 14.20% of outstanding shares sold short, meaning any positive resolution on the legal front could trigger a meaningful short squeeze back toward those resistance. One quick note before you go. This video is for education only, not financial advice. Always do your own research before making money decisions. If this helped, subscribe to Money Clarity for clear investing breakdowns every week.